You guys know I love a good deal, and in the stock market, discounts come in the form of dips and pullbacks. Great investments are even better when you can buy them at a discount. Think about it. If you were buying a rental property, wouldn't you rather buy it at a discount than at a premium? Of course you would. Why should it be any different with stocks? Lots of investors enjoy keeping an eye on the market, standing ready to make a move whenever one is merited. Other people, however, have neither the time nor the inclination to monitor and manage their stocks every single day. This crowd just wants to set it and forget it for years on end. If you're part of this latter group, then there's good news. You have options. Specifically dividend stocks. Here's a closer look at 3 discounted S&P 500 dividend stocks you can feel good about buying and holding forever. But before we jump into these stocks, if you love making money while doing absolutely nothing, congrats, you're a dividend investor. Hit subscribe and let's build that lazy wealth together. Alright, let's jump right into it with our first stock, PepsiCo. For most investors, Coca-Cola is a go-to choice for a consumer goods name, and understandably so. I mean, it's iconic. Not only is it the world's most prolific family of beverage brands, but its namesake cola is also woven into the fabric of culture. But let me tell you, Coca-Cola may not be the best beverage bet for long-term investors. That honor arguably belongs to PepsiCo. Here's why. First, PepsiCo offers a higher dividend yield. Whereas Coke's forward-looking yield currently stands at 2.9%, newcomers to PepsiCo will be plugging their money into a higher forward-looking yield of 3.5%. And remember, while both stocks' yields will ebb and flow over time, the effective yield on your invested dollars is relative to the price you pay. Sure, Coca-Cola has the better dividend pedigree with 63 consecutive years of annual increases. It's a dividend king. But even though Pepsi doesn't have that title, it's no slouch, having upped its yearly payout in each of the past 53 years. And since 2004, its dividend payments have grown measurably faster than Coca-Cola's. Second, while these two beverage giants are seemingly interchangeable on the surface, their businesses are actually quite different. PepsiCo, which also owns snack foods brands like Fritos, LA's potato chips, Doritos and Cheetos, makes the majority of its products in-house. Most of Coca-Cola's production is outsourced to third-party bottlers. PepsiCo's in-house approach gives it tighter control of the entirety of its business, meaning it's nimbler when it needs to be. PepsiCo shares are currently down 20% from their 2023 high, making it a tasty opportunity for long-term investors. Up next, we have a healthcare giant, Merck. It's been a tough past few months for shareholders in Merck. The stock is down nearly 30% since last June for a range of reasons, including slowing sales of Gardasil in China, fresh competitive pricing in the US, December's decision to end 2 oncology drug trials, and disappointing guidance for the current year. Investors are even concerned because the patent protection for its cancer-fighting blockbuster drug Keytruda will begin expiring in 2028. These are all credible concerns. But for true forever investors, these worries just aren't a big deal. Merck stock is a compelling buy, now that its pullback has pumped up its forward-looking dividend yield to about 3.5%. Yes, even though the company is taking measures to prolong the marketable life of Keytruda, there's no denying that the 45% of revenue this drug contributes is in jeopardy. What may not be fully appreciated is that this pharmaceutical giant is very good at finding new profit centers to replace its aging ones. Keytruda, for instance, was added in 2006 when management acquired a company called Organon. At that time, cholesterol-fighting Zocor was Merck's bestseller. Keytruda wouldn't even win its first approval until 2014, when Merck's Remicade, for autoimmune diseases and diabetes treatment. Januvia were making the most waves for the company. CEO Robert Davis said during the company's fourth quarter earnings call, there are 20 potential blockbuster drugs currently in the works, with the collective potential to generate $50 billion worth of annual revenue. Even accounting for a bullish bias, that's a lot of ways for Merck to continue its long-lived legacy of replacing older products with newer patent-protected ones. Lastly, let's talk about AES. Add the AES Corporation to your list of S&P 500 dividend stocks to buy while they're on sale. It's not exactly a household name, although there's a chance your household regularly uses its services. AES is a utility company, More specifically, it's an energy wholesaler, meaning it produces and sells electricity to consumer-facing utilities. This can be a more efficient means of meeting the world's growing power needs. The marketable business model hasn't helped shareholders much lately though. The stock is down 63% from its late 2022 peak and knocking on the door of new multi-year lows, mostly because the company is going through some major expensive changes. It's selling some assets while building new power production facilities and taking on debt to make most of it happen. As of its most recent quarterly report, AES was servicing more than $30 billion worth of long-term liabilities, with just $12.3 billion worth of annual revenue and less than $1 billion in annual net profits. Investors are understandably worried. There's a method to the madness though. While it's messy as well as costly, AES is shifting its power production away from fossil fuels and toward renewables, which are the industry's inevitable future. The company expects more than half of its 63 gigawatts worth of capacity additions slated for this year to be solar panel installations, while nearly another one-third of its infrastructure growth will be battery storage facilities. Such green energy construction isn't cheap, but it's not necessarily any more expensive than more traditional forms of power production these days. And while renewable mandates are still a bit fuzzy, they're coming. AES is ready for them. The company is reshaping itself with the modern era in mind by adding production capacity to meet the soaring demand for electricity with the advent of power-hungry data centers. By selling and delivering electricity directly to data centers, it is addressing the industry's current chief challenge. Although management is in the midst of an expensive transition, it has affirmed an annual target range of 5% to 7% in sales growth through 2027, with per-share earnings projected to grow between 7% and 9% for that time frame. You can plug into AES stock, while its forward-looking yield stands at an impressive 6.4%. So there you have it. 3 discounted S&P 500 dividend stocks that you can buy and hold forever. Remember, investing is a marathon, not a sprint. And buying quality companies at a discount is a recipe for long-term success. Like I always say, time in the market beats timing the market. If this video helped you, hit like. If it didn't, hit like anyway. Let's be honest, it couldn't have hurt. Subscribe for more dividend stock picks and check out this next video before the YouTube algorithm throws you into cat videos.